question of May-June 2015, paper 41. Okay, so here the question is, you have to calculate the net assets of the partnership at 30th June 2014. So when I talk about the net assets of my partnership, let's read. Andy and Nicole had been in partnership for some years. They share profits and losses in the ratio of 2:1. Interest on capital is 15% per annum. I have been given the non-current assets, current assets. Okay. Apart from that, I have been given the capital account of the partners, current account of the partners. Since I have been given two accounts, that means I have a separate capital account and separate current account. It means I am following the fluctuating capital method or the fixed capital method. Two capital accounts. That means I want the capital account to be fixed. It means I am following the fixed capital method. I have current liabilities and my total assets is equal to my total liabilities. In the period Jan to June, there have been certain changes that have happened in the current assets, current liabilities. A loan has been taken out, that means a non-current liability is created. New equipment is bought on the 1st of April. Drawings is there. And they say you have this property of 100,000. You have this property of 100,000, of which 40,000 is related to land. The remaining thing will be related to your property. So land is there and the remaining would be building, and land is never depreciated. That is how the breakup of land and building. They are saying is that all of your non-current assets are depreciated on a monthly basis. That means you are going to depreciate your assets based on use. Equipment is depreciated at the rate of 10% on costs, and property is depreciated at 2% on costs. Okay, calculate your net assets of the partnership. So when I am talking about the net assets of the partnership, what do we basically calculate? We calculate the assets taken over and we calculate the liabilities taken over. Okay, so what are we supposed to calculate? We are supposed to calculate the net assets of the partnership. Let's calculate the net assets of the partnership. Net assets means total assets minus your total liabilities. So what are my total assets? We are answering question number 2A. Total assets minus total liabilities. Let's start with property. Property is of how much? 100,000. Out of this 100,000, what are they telling? 40,000 is related to building. 60,000 is related to, 40,000 is related to land. Here, adjustment number 2. 40,000 is related to land. 60,000 is related to building. And your property is depreciated at 2% per annum. And this is from the period Jan to June. And you have to calculate for 30th June. So property is depreciated at 2% per annum. And from Jan to June, if I am calculating for 6 months. So property depreciation, and this is up till 1st Jan 2014. So 60,000 into 2% into 6 divided by 12. This is going to give me 600. 600 will be additional depreciation, so the net book value will reduce by 600. So when I'm talking about property that is taken over, the net assets for property, it will be 94,000 minus 600, which becomes 93,400. I hope this is clear. Now let's talk about equipment. 26,400 is the value of equipment. You have purchased another equipment of 16,000. So I am going to purchase another equipment of 16,000. So my total equipment is coming up to how much? So my total equipment is coming up to 26,400 plus 16,000. So it is coming up to 42,400. Minus I'm going to do depreciation of current year. It is depreciated at 10% per annum on cost. So the cost of 51,000 is the cost of my old asset, and 16,000 is the cost of the new equipment that I have purchased. It is 10% per annum on cost, so into 6 divided by 12. So 51,000 into 10% divided by 2. So it will come up to minus 2,550. Current year depreciation of old one. And the new asset I have bought for 16,000. 16,000 into 10%, and I'm using it for April, May and June. I'm using it for April, May and June. So I'm using it for 3 months. So 1,600 divided by 4. So 400. So the new value of the equipment will be 42,400 minus 2,550 minus 400. So it is coming up to 39,450. Equipment is coming up to 39,450. Let's go to the next part. They are saying current assets increased by 20%. So these are my total current assets. This is increased by 20%. So into 120%. So it is 13,100 plus 19,100 plus 600. So this total is 32,800 and it increased by 20% into 120%. So this is coming up to 39,360. So when I'm talking about my total assets, I have to calculate net assets. Net assets, the other meaning of net assets is total assets. So it would be, other meaning of net assets is capital, I'm sorry. So it would be total assets minus non-current liability minus current liability. This would give me my net assets. So I have property. I got the new value as 93,400. I have equipment. I got the new value as 39,450. And then I have current assets. The value that I'm getting is 39,360. The total of this is 93,400 plus 39,450 plus 39,360. The total of this is 172,210. Now current liabilities increased by 10%. 10,800 into 110%. So current liability it will become 11,880. Then a long-term loan was taken out. So minus non-current liability, which is a long-term loan, 8,000. It is the long-term. Drawings amounted to drawings would come in the partner's capital account or current account. It will come in partner's current account. So my net assets would be 152,330. Okay, so this I have answered the A part. Now what is the B part? Calculate the profit for the period 1st Jan to 30th June. That means they want the profit for 30th June. If they ask you to calculate profit with the help of net assets, how will you calculate? You will prepare a capital account. You know the net assets on 30th June that you just calculated. You have calculated the net assets on 30th of June. So the closing capital is 152,330. Calculate the opening capital. And you have drawings also. What is your total drawings? 3,000 for Andy and 6,170 for Nicole. So 3,000 plus 6,170, this is 9,170. Calculate your opening capital. Net assets. Opening net assets would be the opening capital. So it is 120,000 plus 22,400. So 142,400. Now do the total of this and get the profit. So it is 152,330 plus 9,170. So this is giving 161,500. 161,500 minus 142,400. So your profit is 19,100. So you've got it. How would you do CTD? You should remember. Closing net assets. You can't use capital because they have used the word net assets. Plus the drawings minus opening net assets would give me my profit. What is closing net assets is 152, 330. Drawings is 9170. Opening net assets was 142, 200. You got your profit of 19,100. Now, on 1st July 2014, Zola was admitted to the partnership firm and they have given you the following information. New profit sharing ratio is 2:1:1. Interest on capital was increased to 20% per annum for all the partners. Zola has bought into the business 10,000 in cash and new property. Original partnership property was revalued. Goodwill of the business was valued at 12,000 at the time of Zola's admission, and it is not to be retained. The profits for 6 months was 23,000 and the drawings was this much. You are required to prepare capital account and you are required to prepare current account. Let's first prepare partner's capital account. I know the format of my partner's capital account. My partners are A, N, and Zola. My partners are A, N, Z, A, N, Z. Capital account would increase or decrease only because of additional capital, goodwill, revaluation, profit or loss. Am I correct? So let's do that. This is the partner's capital account. So we have partner's capital account and we have partner's current account. The first thing we will do is we will go to the balance sheet and get the capital account balances, Andy and Nicole. So for Andy and Nicole, the capital account balance, the balance begin down is 70,000 and 50,000. The current account balance is 20,400 and 2,000. Okay. Now, what have they told you? They have brought in Zola as a partner, and the new profit sharing ratio is 2:1:1. Interest on capital was increased to 20% per annum for all the partners. Now let us see what is the interest on capital initially. They have not told us anything about interest on capital initially, but what is the current capital? So if you see, I have the statement of financial position on 1st Jan. Old interest on capital was 15%. And I have admitted my partner on 1st of July. That means from Jan to June, I will give my partners interest on capital at the rate of 15%. And from July to December, I will give them interest on capital at the rate of 20% because interest on capital is increased to 20%. So the old interest on capital, I will give them on 70,000 I will give them on 70,000 15%, but for 6 months. So 70,000 into 15% into 6 divided by 12. So old interest on capital is 5250, and here it would be 50,000 into 15% into 6 divided by 12, it is 3750. This is before admission of the partner Zula. Tell me, will I put interest on capital in capital account or in current account? I will put it in the current account. So it is 5250 for Andy and 3750 for Nicole. After that, Zola has brought in 10,000 in cash and a new property of 60,000. Additional capital. She has brought additional capital in cash and property, 10,000 cash, 60,000 for property. Original partnership property was valued at 154,000, was revalued at 154,000. That means you had a partnership property which was 94,000. I have revalued this as 154,000. So I have a profit on revaluation of the property. How much is the profit on revaluation? 154 minus 94, which is 60,000. This profit on revaluation will be going to partners' capital account. In what ratio? In their old ratio, 2:1. So Andy and Nicole will share the profit on revaluation in the ratio of 2/3 and 1/3. So what is the profit on revaluation? Original property was revalued at 154,000. What was the old cost of the property? 94,000. I'm really very sorry. The property was revalued at 154,000. But I have calculated the new value of the property as 93,400 when I calculated my net assets after doing all these adjustments from Jan to June. So I have a profit on revaluation of 154,000 minus 93,400. I have a profit on revaluation of 60,600, which will be shared between Andy and Nicole in the ratio of 2:1. So Andy will get how much? 40,400 and Nicole will get 20,200. Revaluation profit or losses is transferred into partner's capital account. So it's a revaluation profit. So 40,400 will go to Andy and 20,200 would go to Nicole. Now goodwill of the firm is valued at 12,000. You know that whenever you have partnership, you raise the goodwill amongst the old partners in old ratio and you write off goodwill amongst all the partners in the new ratio. So I will raise the goodwill in the capital account and I will write off the goodwill in the capital account. You should know that capital account changes only because of revaluation, goodwill adjustment, and additional capital. So I will raise the goodwill of 12,000 in the ratio of 2:1 and I will write off the goodwill in the new ratio that is 2:1:1. So goodwill raised among the old partners in old ratio would be 8,000 and 4,000 and written off amongst all the partners in the new ratio that would be 6,000 3,000 and 3,000. The profit for 6 months ended is how much? December 2014 is 23,000. Can you tell me where will this profit go? And during this period, drawings was 3,000, 7,400 and 4,100. So the drawings was 3,000, 7,400 and 4,100. I remember there was an old drawings also of Andy and Nicole from Jan to June. So there was old drawings also of Andy and Nicole from Jan to June, and this is from July to December. So from Jan to June it was 3,000 and 6,170. Similarly, interest on capital also, this was from Jan to June 15%. And again interest on capital we will give at 20% from July to December. So 70,000 into 20% into 6 by 12. So it becomes 11,240 for Andy. Let's calculate for Nicole. 50,000 into 20% for 6 months. It will become interest on capital from July to December. From July to December, when I am calculating capital, I will have to calculate the new capital of the partners from July to December. So I will wait for this calculation for interest on capital. Okay. Is there anything else? During the year, Andy made a drawings of 6,000 and 12,900. You have to calculate impact on capital. So this is at the later stages. I will close the capital account. I have 70,000 here, 74,200 here, 118,400 here, 118,400, 74,200, 70,000. I will get the balance of my new capital. So this is 112,400, 71,200 and 67,000. Now this new interest on capital that is there, I will calculate on the new capital. So 112,400 into 20% divided by 2. So the new interest on capital is 11,240. For Nicole it will be 71,200 into 20%. For 6 months it will be 7,120. And for what is his name, Zola, it will be 6,700. Then I will close my current account. Okay. Is there any share of profit? Let's check. New profit sharing ratio is there. Interest on capital is there. Interest on capital, please remember that after partnership, it will be on the new balances. Additional capital is there. Revaluation profit or loss is there. Goodwill distribution is there. Okay. Profit for the 6 months was 23,000. Is there any old profit? Please check, is there any old profit? Okay. So profit for the 6 months is how much? 23,000. 23,000 will be distributed in the ratio of 2:1:1. Please distribute it. So now you also have to distribute the profits amongst the partners in the current account. So share of profit. So if you see over here, for the first 6 months, you had a profit of how much? 19,100 from Jan to June that you calculated. So this was your profit from Jan to June. This was your profit before appropriation. 19,100. From that, you will minus your interest on capital. That is how much? 5250 and 3750. So 19,100 minus 5250 minus 3750